So basically, this is the best part of the program. Individuals, because it affects everybody here. The rest of the stuff is just entertainment type of stuff for your enjoyment. So, what happened? Basically what happened is they took a top tax rate of 39.6 and they brought it down to 37%. They expanded the brackets and they lowered everybody's tax rates. So, in a nutshell, this is what happened. Did it happen permanently or temporary? So the 21% corporate tax rate, until there's a change in administration in the government, that's permanent. We're talking 21%. That's not going to change until another administration comes in and changes the law. This is temporary. You have 8 years, and then everything goes back to the way it was. So you got 8 years of 37%, and then you're going to go back to 39.6. So if everybody remembers when this was passed, there was a woman, not to get political, Nancy Pelosi from California, this is going to crush the middle tax or everything. She's talking about when it goes back. But, you know, it doesn't surprise me that Nancy Pelosi would say something like that, but it is what it is. So that's the nutshell. Basically, tax rates went down for individuals. So everybody's a winner, right? Not exactly. Kiddie tax. Anybody fill out kiddie tax returns before? Try to do your own taxes on TurboTax or whatever? The old days, basically, kiddie tax, you couldn't complete a child's tax return until the parent's tax return was done and all the siblings were done, because you had to tie it into the parent's tax rate, so it took forever just to do a simple child's tax return. Now, they made it simple. If you have earned income, i.e. wages, the kid was working at the pool as a lifeguard during the summer, he gets a W-2. And then any type of bank statements is unearned income, you know, the bank interest or the dividend statements, because grandma gave her GE stock or whatever. The earned income will be at the individual's rate. Any unearned income will be taxed at the trust rates. Trust rates, basically, there's smaller brackets to ratchet up. So there's really no major play there saying, oh, okay, let's move all the money into the kid's name. This way they're going to pay less tax. The trust rate brackets are much smaller than the individual brackets, but at least you can get the kids' tax returns done on time. AMT, gone for corporate, not gone for individuals. But AMT is now the way it was supposed to be. Basically, when AMT was first thought up, they said, if you're in an industry where you're getting preferential tax treatment for something, i.e. mining, certain construction with long-term contracts, along those lines, and you're not paying any tax, people are saying, what does everybody say, kids all the way up? That's not fair, right? That's not fair. So the government comes in and says, okay, we're going to have another tax scenario where you're going to add back certain benefits that you got, recalculate your tax using a lower tax rate. Whatever the greater is, you're going to pay that tax. That differential between what your regular tax was and the new tax rate is called your AMT. So now it's basically going to go back to the way that it was, i.e. if you're in a preferential industry where you're getting some benefits, you would pay the AMT. State and local taxes, no longer deductible, which we'll get to. That was the biggest piece of AMT. I'm sure if you look around, if I would raise hands and say, who's in the AMT, I'm sure more than half of the hands would go up in this room. Under 2017, that is. Affordable Care Act. So basically, when they passed Obamacare, they basically said if you don't have insurance, we're going to penalize you on an individual return, and don't worry, the IRS is going to legislate that. So no different than the government is going to determine your health care, not your doctor. Now the IRS is going to collect penalties for not having health insurance. So basically they just said, you know what, the IRS has enough to do to worry about whether or not someone has health insurance or not. So that's off the table. There's no more penalty through the tax returns for not having health insurance. Standard deduction. Everybody remember Paul Ryan standing up there with the index card? You can now fill out your tax return on a postcard and mail it in, as long as you don't have any other itemized deductions. So if you work for Apple in Texas and you don't have a state income tax and your real estate taxes are $800 a year, you basically can have a standard deduction. So yes, that's the postcard. What they did is they took the standard deduction rates to give a benefit and doubled them, to say, wow, you're going to hit a home run. If you're in the Northeast, high home values, where you have big mortgages, people in the Northeast are generally charitable. You had the state and local taxes, which is now gone, but you had that in the past. A lot of people itemized. Miscellaneous itemized deductions people had, investment fees and all of those things, they itemized. So it was really not much of a play here, but they doubled it. Did they really double it? Well, I just want to get to the next slide. The personal exemptions are gone. So if you take basically the old rules, married, no kids, with the personal exemptions, you're basically going to be where now, with no exemptions, what the standard deduction is that they're going to give you, at the $24,000. Under the old rules, that was the standard deduction plus the 2 personal exemptions you would get if they didn't phase out. So there was no real great thing done here. It was kind of like a charade game, but people fell for it, basically saying, oh, wow, you're doubling the standard deduction. Yes, but you also took away the personal exemptions. Who does this really hurt? This really hurts basically people with lots of kids, young kids, but as you'll see later on, they try and fix that a little bit. So anybody here a CFO or a controller or a payroll person? So there's going to be a Twilight episode this Saturday on Channel 13, 11 o'clock. Basically, it's going to be, how do I have somebody complete a W-4 when there's no more personal exemptions? Think about that. No? Okay. Tough crowd. If I get no respect, Ronnie Dangerfield, right? Jeff mentioned it before. Basically, what happened here is Congress and the Senate, they teamed up with the American Heart Association because we're looking out to everybody's benefit here. No more SALT. SALT is no more state and local tax deductions. So if you're in the Northeast or you're in California, maybe Illinois, basically you're screwed, right? Basically, you pay ridiculous taxes because you want the services. My brother lives in South Carolina. He's on 17 acres. He burns his garbage in his backyard, and he can fire a gun into the woods and not have to worry about hitting anything. He pays like $300 and something in real estate taxes. Does anybody here burn their garbage in their backyard? No. So our real estate taxes are a little bit up. Basically, the SALT deduction, they're going to let you deduct the maximum between state and local taxes and real estate taxes and foreign taxes, if you so choose want to deduct those, of a maximum of $10,000. If there's anybody in this room that can stand up who owns a residence that can say this real estate taxes are less than $10,000. All these people standing is amazing. Everybody look around. So, again, people in the Northeast got screwed. Mortgages. If anybody's thinking of buying a residence or a second residence, you used to have $1 million cap, really 1.1 when you included the equity line, but you had $1 million cap for acquisition indebtedness. They dropped that down to $750. So everybody's going to be looking at a little bit smaller residences now as you buy them. They also got rid of the equity lines and the equity loans. So in the old days, if you took out an equity line of $100,000 and you went out and you bought a car, saying, I can deduct it, no big deal. You can't do that anymore. Open up an equity line to finance your kid's education, can't do that anymore. It's not deductible. You can still take out the line, you just can't deduct the interest. Next piece, medical expenses. Something benefit, I guess, if you want to call it, if you actually qualify for it. So they raised the rate for if your adjusted gross income, they raised it to 10%. So any medical expenses that exceeded 10% of your adjusted gross income, you were allowed to deduct it. They dropped it back down to 7.5% where it used to be. They're doing it for 2 years, 2017, 2018. Watch for them to extend that. There's a audit partner in the room when we first presented it to the audit partners. He basically said they're going to stick it to the old people, the government. Well, they didn't really want to do that. They got enough problems with, you're taking my Social Security. So basically they put this back down to 7.5%. Charitable contributions. So those people that are lucky enough to actually itemize their deductions, they saying in the past the maximum charitable contributions that you could take was limited to 50% of your adjusted gross income. They raised that to 60%. The charities are a little bit concerned, thinking, a lot of people aren't going to be getting itemized deductions anymore. What's the likelihood that they're going to contribute to give in accordance with their prior charitable giving? Waits to be seen. Casualty losses, gone, unless it's a presidentially declared disaster area. So in the old days, you had a fire or, I remember when I first started in this profession, somebody bought a residence on a little island out in Suffolk County, way out east, just a little bit north of Sag Harbor. He had a deer infestation. The sound froze. The deer walked over to his house, ate all his rhododendrons, his bushes, and everything else. He turned to the insurance company. He said, all my outside gardening and everything is gone. And they said, that's not insured. So we wrote off a casualty loss for a deer infestation because he had all sorts of, fancy plants and bushes and stuff from all around the world and everything. That's now gone. You can't do that. Gambling losses. Anybody know what this Sunday is? Anybody? Bueller? Anybody? Anybody know where that reference is from? Ferris Bueller's Day Off. Okay, whatever. How much money is going to be wagered this Sunday on the Super Bowl? Any idea? Not just Vegas, all around.
Millions.
How many billions?
5.
Close. $4.7 billion is going to be wagered. Only 3% in Vegas, which I didn't think gambling was legal anywhere else. They're trying in Jersey, right? But so $4.7 billion in gambling this weekend. So basically the rule is you can deduct gambling losses to the extent of your gambling winnings. But there are these things out there people out there called professional gamblers, right? You watch the, men are sitting around at night watching TV, they have nothing to do. Ooh, the professional poker tour is on. I'm going to watch this. People play, poker or whatever, and all these millions of dollars changing hands with the chips. Those are professional gamblers. So now you can deduct the full expense, the full experience, I should say. So if you take your spouse to Mohegan Sun to gamble, you have the meal, you have the hotel. If you hit it big, you can deduct the losses to the extent of the winnings. So don't think you're going to be able to write everything off. You have to have winnings. You can deduct the losses to the extent of your winnings. And the other piece is you have to itemize. So you have to actually be able to itemize with no state and local taxes and $10,000 on the real estate. There's really, not much of a play there, but it is. They're trying to put you on par with the professional gamblers. Any investment people in the room, brokers or anything, your investment fees are no longer deductible by the taxpayer as a miscellaneous itemized deduction. So, stay tuned for that. Any employees that basically have miscellaneous unreimbursed business expenses, gone. That doesn't exist anymore. So itemized deductions are now gone. Alimony. Anybody out here thinking of separating or getting divorced? If you're going to do that, not that I'm recommending that, but if you're going to do that, it's recommended that you have an agreement in place by December 31st, 2018. So they're giving people a year to figure this out. So you have a year to figure out if you want to separate and to have an agreement in place. If the agreement is not in place by December 31st, 2018, any alimony payments are not deductible, and any alimony receipt is not includable in income. So what is the major play here? The play is, let's just say the high income earner may or may not say that they want to split. The spouse maybe doesn't work. So the high income earner, if I'm getting a tax deduction, I may be more likely to pay a little bit more money in alimony because out of guilt or whatever the case may be. Somebody's picking it up at a lower tax rate, the spouse feels a little bit better. You enter into the agreement. This happens in 2018. Now you're stuck with New York State legislates. Now they tell you exactly what you have to pay in support and in alimony. People are going to basically say, New York State is this, there'll be no more guilt, so there'll be no more chance to negotiate a better deal under the alimony rules. Moving expenses, no longer deductible unless you're in the military. So they tell you have to move to Afghanistan, then yes, those expenses are going to be deductible because you're in the military. Anybody else, moving expenses no longer deductible. Student loan indebtedness, discharge from indebtedness picks up as income. Sometimes there's some provisions in student loans that basically say if you work in some, charitable place or something, we'll forgive a part of the loan, and then you're not going to have to pick it up as income. Now they basically said if you die or if you become disabled, you don't have to pick up that income either. Little benefit, I guess, but I'm not sure the alternative to get that benefit is any good. Child care credit. This is where the home run comes in if you have kids or want to have kids. Basically, you can get a child care credit of any child under 16, $2,000 a kid, provided your income is under $400,000. So I missed the boat a little bit. My kids, I got a 18 and a 17-year-old, but I do have a 13-year-old. Trying to talk to my wife about more kids, she's really not interested. She doesn't want to go back to the diapers or whatever. But it is out there, so you're losing the personal exemptions, but you're going to be able to pick up a child care credit. Qualified equity grants, in a nutshell, if you're starting a new private company and you want the whole company jazzed up and you give some sort of an equity play to at least 80% of your employees, there's a benefit for those employees where you can defer the income tax on that grant of equity for up to 5 years. So, in the old days, I'm just going to give it to my senior staff, the equity play or whatever. Here, if you do it for the whole company, 80% of the company. Recharacterization of IRAs. Everybody remembers several years ago where there was a play, you could take some of your traditional IRA, recharacterize it to a Roth IRA, and pay the tax over 3 years. That was just a quick bang to get the money into the government. If you're thinking of taking a traditional IRA and converting to a Roth, and you take the transaction, you do it at the beginning of the year, and then the market tanks, when you're ready to file your tax return, you're probably saying, crap, probably shouldn't have done that. The old days, you could unwind it. You can't unwind it now. So once you make that decision to go to a Roth IRA, you're stuck with it in terms of a conversion. There's no unwinding anymore. IRA rollover payments. So basically, let's just say you change jobs and you have a loan out on your 401k plan. When it rolls, if you don't repay that loan before you leave the company, it's treated as a distribution. They give you 60 days to basically repay that loan. Now they're going to extend that, and it's going to be up until the point you actually file your tax return. Distributions from qualified tuition plans. So basically the 529 plans. In the past it was for college kids. Now they're basically saying that if you have a plan, you can use it for elementary and secondary schooling, private schools, charter schools, all of those pieces. Or if you're a grandparent and your grandkids, have these 529 plans, or you're able to move the 529 plans between different grandchildren or whatever, you can now use it to pay for secondary and private schools. Like-kind exchanges. The old rules, you could like-kind exchange almost anything other than stocks and bonds. So a lot of people would like-kind exchange equipment. Now it's strictly real estate. Is it a big loser? So can I take my backhoe that is beyond its useful life, but somebody may still use it, and I want a new backhoe? You get hurt by this because the old days used to use the tax 1031 exchange for that? No, because under the new depreciation rules, you're just going to write the thing off 100% anyway. So you're really not hurt by this move. The next piece, this is not really a good part of the law. So basically, if you go into an investment now, you're an individual, a non-corporate taxpayer, you go into an investment, the maximum loss that you can deduct is $500,000. So if you have a loss greater than $500,000, it's going to get, you're not going to lose it, it's going to get carried forward. So they would always say, do you have, the rules scenario why us CPAs get to have jobs is we would say, what's your basis? And do you have at-risk basis? And then is the activity passive? That is another hurdle. Is the loss greater than $500,000? If it's greater than $500,000, that's the maximum you take is $500 if you're married, $250 if you are not. The balance of the loss will go forward. And then this is the last part, which basically sums up this whole tax law. So basically, if you have self-created property, a patent, an invention, a design, a secret formula, that used to be capital gain if you sold it. Now it's going to be taxed at ordinary income rates. Where's the exception? The exception is for musical compositions. That's still going to be treated as capital gain property. So if you are fortunate enough to basically discover the cure for cancer, and you sell it to one of the big drug companies, you're going to pay ordinary income on that. But if you have an emotional relationship heartbreak and you write a song and sell it to Taylor Swift, that's capital gain treatment. Think about that.